Welcome to the Fintech One-on-One podcast, episode number 303. This is your host, Peter Renton, chairman and co-founder of Lendit Fintech. Before we start this episode, I want to tell you about a brand new event from Lendit Fintech. Fintech Nexus, the Dealmakers Summit, will be the first major in-person fintech event of the past 18 months. A hand-curated audience of venture capitalists, bankers, fintechs, and debt investors will be meeting face-to-face at an event 100% focused on doing deals. It will be happening in Miami on September 1st and 2nd. You can apply to join and find out more at lendit.com. Today on the show, I'm delighted to welcome Steve Muszynski. He is the CEO and founder of Splash Financial. Now, Splash is a really interesting company. They've created a loan marketplace. Unlike pretty much anything else that's out there, they are focused on the student loan refi market right now, and they work with banks and credit unions, and they integrate tightly with these lenders in an interesting way, which we get into in some depth. We also talk about their underwriting and how they're applying automation to be able to automate many loans. We talk about the different ways they work with these community banks. I talk about their big funding round that they just closed and much more. It was a fascinating interview. Hope you enjoy the show. Welcome to the podcast, Steve.
Thanks, Peter. Really excited to share our story.
Okay, well, let's get started by just giving some background to the listeners. Why don't you give them some of the highlights of what you did before Splash?
Yeah, so I am proof point that you don't have to have experience in a space to start a company. And so, I graduated from Ohio State in 2011 from their honors business program. And then I went to work for GE in their financial management program, which is training business line CFOs to run different components. So I was in the energy sector, and when I went to Ohio State, I had a student loan. My parents took out a loan for me. A lot of my friends had student loan debt. And it really was around the concept of the government was charging people 7, 8, 9% in interest rates on their loans. The idea for Splash was trying to figure out a way to privatize a portion of the market to help people not have to get stuck in so much debt. But like I led with, I knew nothing about the space. And so diving in, definitely was a challenge.
Okay, but so obviously when you started doing your research, you would have found, companies like SoFi that have already been doing this. At least they really started the refinancing movement, certainly in the last decade. But so what was it that sort of, tell us about what you wanted to do, seeing that there were others out there. What did you want to do differently?
Yeah, so this was 2013. So at the time, SoFi wasn't really doing refinancing. SoFi was still running their model of connecting alumni at colleges to undergraduates to finance their social financial loan, which was the name SoFi.
Yep.
The concept for Splash, and at the time it was actually a company called LendUlink, and eventually it migrated into Splash, was trying to help parents save more for their child's college education. And so trying to help people not have to take out as much debt.
Right.
But we were utilizing deposit data that they would save in banks and credit unions to create better analytics around a student loan. So if they needed to borrow for their child, instead of going to the government's Parent Plus loan program, they could take out a loan with their private bank or credit union that would leverage their deposit history to know that they were a good risk to lend to. And in theory, that would allow the private lender to offer a better rate than the government.
Right. So you started doing that, but then when did you, well, tell us a little bit about the history then of Splash and when you pivoted it. I know it was, it used to be called grad school loans, I think, and you're focusing on like medical students, but tell us a little bit about that trend, the history there.
Yeah, so we went through a couple paths with the company, and The initial concept holds a lot of merit. There are some challenges with the model that you learn when you're a first-time founder. And I think a lot of times you really need to be willing to pivot and be open to market feedback. And it was very challenging, since one of the issues with the original product was that banks and credit unions need to reserve capital the minute that they approve someone for a loan. So if you're a parent and you're saving for your child, and your child's in sophomore, junior year of high school, and the bank says, great, you're going to be approved for this loan, so you know that you don't have to go to the government anymore. The minute that happens, even if you don't end up taking that loan in the future, the bank needs to reserve capital against it. And so the unit economics just did not work on that product. And as we were working on it, we realized that SoFi had navigated into the student loan refi space. It was a very hot sector. And we saw an opportunity to help a lot of my friends that were in medical school, had just graduated and started the residency. And the unique element of these professionals, these doctors, is that they don't make very much money, but they have a ton of debt. Mm-hmm. So they have they might make $60,000 and have $250,000 in debt. And at this time, SoFi actually did not have a product for medical residents and fellows. So Splash was one of the first companies to launch a product to help these doctors refinance their student loans, defer their payments while they're in training. And 3 months after launching that, SoFi rolled out a competitive product.
Right.
And so this was actually a really good thing for us, because it helped us really take a look in the mirror and think about the bigger picture of why do we exist as a company and what value are we trying to bring into the world. Mm-hmm. And this was how we really came up with the evolution of Splash. This was back in 2017, and this really started the ideation phase of where we're at today, where we wanted to marry bank and credit union capital. The community banks and credit unions, not necessarily the top tier banks that have all the technology and the major investment, but the ones that are unable to participate in the digital infrastructure and digital ecosystem. Let's try to marry those financial institutions with a traditional marketplace model in order to help consumers win and gain access to lower rates, better experience. And so that's where what we really set out to do in 2017. And I think we've succeeded in a large degree at this point, and we're always trying to push the envelope, but we've definitely allowed for billions of loans to be financed by lenders that consumers wouldn't have known existed without Splash.
Right.
And that via our automated lending platform has helped make the process incredibly easy for consumers. It's helped banks and credit unions gain access to new customers, and I think it's really been a win for everyone, but it's definitely been a non-linear journey, in trying to figure out product market fit.
Right. Understood. So maybe you can describe the marketplace in a bit more detail, and also tell us how you're different from other student loan marketplaces. We know there are certainly there are others out there. So tell us a little bit about that.
Yeah. So we love the marketplace model. I think the companies out there are doing a great job. There's been a lot of innovation over the last few years that allows consumers to fill out one form and gain access to a network of lenders with a soft credit pull and get real offers. And I think that's a major evolution since the click outs, where you have to land on a page, click on an offer, go through a hard pull, go back to the page, do the same thing 10 times over. And so the unique element of Splash is we do that too. You come to Splash, you fill out a form, you gain access to a network of lenders with real offers. But we go a step further in owning more of the tech process and really working maniacally to add more lenders into the market that don't exist today. And that's, I think, where there's a clear differentiation. In a lot of marketplaces are repurposing existing offers from, could be a lender, it could be from, just a bank that has a savings account or a credit card or whatever it might be, but they're repurposing offers. At Splash, we built the technology to allow banks and credit unions to launch a product. And that allows for us to have better access to credit, better ability to approve people, and traditionally lower rates.
Okay, so then how does it work? Because most, when I mentioned every bank and credit union is going to be slightly different with what they want. Some of them are going to have a pretty similar credit box, I would think. But how is it with having, a dozen, whatever, more banks and credit unions? I mean, is it helpful? Because, are they all different? Or tell us a little bit about the requirements that your investors have.
Yeah, they actually are all different. Everyone looks at credit a little differently. And while it may be nuanced or slight, every differential allows for a better ability to approve or price. So we have some partners that are willing to go lower on FICO, depending on other criteria. We have other lenders that are willing to go higher on debt to income based on certain criteria that could be degree, it could be, major, many different credit aspects. But when you add up all of these different ones, you're able to approve more people. There are lenders in the market, not just on Splash, but everywhere, that have very small school lists. And so the consumer doesn't know this. You might be sitting there with an 825 FICO, and you go to one particular lender and you might get denied because the school that you graduated from is not a school that they accept. And so when you just look at things like that, by going to a marketplace like Splash has, you can just gain access to many different credit boxes, pricing guides, and things like that. So I would say they do price differently to provide coverage to more consumers.
Okay, so then do you work with any school? If someone's gone to a 4-year school, what are the limitations there?
Yeah, we work with any school. So as long as you've graduated, and we're working on expanding our model today to allow for refinancing if you haven't graduated. That's something that we really find important to provide greater access to credit, as that's one of the things that we really care about as a company. But today you have to have graduated from your degree. It could be a 2-year program. It could be a 4-year program. So, it doesn't even necessarily only have to be a 4-year. We even can do for-profit schools, which a lot of lenders shy away from. I think that there are some major challenges in higher education, obviously, in pushing people towards for-profit schools, and the amount of people that maybe don't graduate and get stuck in a debt cycle. But if you've graduated from one of these programs, why should you be stuck with a private loan that you took out originally that's 11, 12%? It was really important to us to try to figure out some solutions to help some of these people refinance to a rate that could be 4% range, as an example, and so that was important to us. And so we have that option as well.
So you're focused on bringing in new lenders. Do you also work with lenders? I imagine there are some that would have an existing program, or do you really shy away from them? What's the mix like that?
Yeah, we work with them as well. The way we think about it is trying to serve the consumer as best we can. And a lot of marketplaces really shy away from bringing on some of the largest lenders due to the fees that those lenders might pay, which is kind of ridiculous when you think about it. But it makes sense from a business perspective. It's kind of frustrating from a consumer perspective that you go to a place and you say, hey, I want access to the market, and now you don't get access to the market because of a fee negotiation issue with the platform and the lender. Mm-hmm. So we really try our best to bring on as many partners as possible and to make it work for everybody. And so we kind of break our partners up into something we call an API partner and a full platform partner. The full platform is going to be running on Splash's loan origination system, which we're focused on automated loans, trying to make loans without human intervention and doing it as quickly as possible. We have a very robust underwriting and credit team that works on behalf of our bank and credit union partners. But the API partners are really the ones that you just mentioned of, if you have an existing product and you have the ability to pass over your rates, we will enter a consumer will enter the information on Splash. We'll send you information. You will send us back your rates. And in many instances, those will be the rates that are presented to the consumer. and the consumer could possibly finish that application on that lender's website. And so we really try to marry the best of both worlds.
Okay, so then are you able to, I know that is the model that most marketplaces go to, that at some point in time they hand it over to the lender's website. Are you also able to sort of complete an application just on Splash, and how does that work?
Yeah, so for people that are fully integrated into our full tech stack with our automated lending platform, we would do everything for them. So it's a complete service. We will even do loan disbursement files, boarding the loan onto a servicing system. So we do everything. We approve right now about 2/3 of our loans inside of 24 hours. We have a subset of that are approved inside of an hour, and a subset of that are approved in just minutes. We're working to approve loans instantly. And so that's the focus for this year, is to actually allow us to be able to approve loans in seconds for lenders that are fully embedded in our technology.
Right. Got it. So can you give us some names here? I mean, when I was doing some research here, I noticed you had, PenFed, there was some news out about them. They were a major partner of yours. It was a couple of years ago now that I saw it, but can you tell us some of the lenders that you're working with?
Sure. Yeah. So PenFed's been a great partner of ours. First Tech Federal Credit Union. We work with Teachers Federal Credit Union. We also work with a few banks, Fulton Bank, Westfield Bank, and we continue to bring on additional lending partners that are in the pipeline. But right now, we're able to provide some amazing rates from these partners. And the way that they think about it is, and this is, I think important, bank and credit unions just have a capital advantage when you think of their cost of capital. Mm-hmm. And community banks and credit unions especially are struggling to gain access to millennials and Gen Z. Right. When you combine those two items and the overall fight right now for consumers, when you're looking at neobanks and fintechs, and then you're looking at the competition going on between them and banks and credit unions, a lot of these small institutions have been completely left out. And so Splash, we kind of can act as that access point, that technology platform that bridges the gap and provides them access to these consumer segments. And when you combine that with their cost of capital advantage, they're able to offer incredibly low rates. And so that's where our focus is, primarily as a company, continuing to add on more of these partners and really being that access point that sort of is the fintech that's working on behalf of the banks and credit unions to help them gain access and scale. That's really where we want to play.
Right. Okay, that makes sense. So then, can we talk a little bit about the loans themselves? I mean, obviously you're working with a bunch of different lenders. Everyone's going to have slightly different rates and credit boxes, as you said. But what's the range? What's a sort of a typical rate and loan term that you're underwriting?
Yeah, so the general range, and obviously this is specific to the month and time because it's highly interest rates sensitive. So rates right now are at all-time lows. It's really there's been some mass competition that actually has a couple components going on. You have COVID and the mass reduction in interest rates that occurred as a result of that drove the LIBOR rate down, and essentially cost of funds for many lenders are still low. So rates are at an all-time low, but many people have seen rates kind of go up since then. And in most asset classes, when you look at mortgage and others, I mean, rates have ticked up, but student loans, refi, have not. And that's because the government right now has a policy that has paused federal student loan payments and reduced interest rates to 0%, a bit of a payment holiday, due to the challenges that COVID has caused to the labor market, especially for people searching out their first-time job. That's set to expire at the end of September. So essentially, you have a massive TAM reduction, mm-hmm. where you might have $1.7 trillion in student loans, and maybe $500 billion are really good credit, so they would get a great rate at a refi company. But only $100 billion of those are private student loans. So if you think about that, the total addressable market is 20% of the size. So there's a bit of a food fight right now with all lenders trying to gain access to the remaining customers that are looking to refinance. So that's driven some major rate compression. So we're seeing average rates in the threes right now, fixed. Wow. I mean, it is very low.
It's like a mortgage.
it is like a mortgage. We are seeing like the low rate fixed for us right now this is a point in time. So this is May of 2021, or Peter, I don't know how you want to deal with the time, May
of 2021. That's fine.
Yeah. So this is May of 2021. So the low rate on our platform is 2.54% fixed. This is lower than a mortgage that you would get. And that's crazy because it's unsecured consumer credit. Yeah. The terms range on our platform from 5 years to 25 years in payback. And, you have many options in between those, but the rates are just incredibly low. And that's great. It's able to, we get reviews all the time of people that say they dropped the rate from 10% to 3% or 11% to 4%. And the amount of money on, let's call it $100,000 loan, is staggering.
Oh yeah.
Like you can compound that and figure it out, and you could be saving that person 30, 40, 50, maybe even $100,000 depending on the loan term. Right. That is life-changing amount of money. So that's why marketplaces, not just Splash, the other marketplaces I think out there as well, are important to allow people to actually compare offers, because that person might have gotten denied if they just went to one lender and then given up and be saddled with this debt. And so that's why marketplaces in general are pretty important.
Yeah, for sure. So I wanted to spend a second, if we could, on your underwriting. You mentioned that you're trying to move towards, instant underwriting, but maybe you could tell us a little bit about how your underwriting process works now, what kind of data you're using, and how you're trying to move towards automated.
Yeah, so every lender has different credit underwriting, right? So we essentially underwrite on behalf of them with many different data points. So depending on the data points that they have, it could or could not allow for an automated underwriting process. We are trying to move as much to auto underwrite as possible, but essentially underwriting is a series of rules, right? So what you're doing is, whether a human does it for the most part or whether a computer does it, it's just a checklist and a guide. It's making sure that things are done properly. So as technology has evolved and has companies like Plaid and others have really provided greater access to what's called first-party data or real-time data, you can actually reduce fraud by tapping into some of those data systems, not ask for a pay stub or not ask for a diploma, which all it takes is some really good Photoshop skills to be able to fudge that.
Yep.
But working with back-end data systems to pull real-time info will allow for the automation. And so right now, our loans really have an auto assist. A lot of the back-end is automated. We just have humans that double-check everything until we can confirm that we feel confident in the models and the process, that there's not going to be a loan that slips through that really should have gotten a different rate or something like that, as it is obviously on behalf of our lending partners. So that's pretty important. But right now we have an auto assist where a lot on the back end actually is fairly automated.
Right. And so for those banks and credit unions that really you have your loan origination system they're using, I mean, I imagine then that you have their complete credit box, you have like you're not going back out, or are you going back out to the lender for approval, or do you know this is approved?
We know, and that was a really important part of the model, because there are systems that require you to go back out to the lender, and a lot of these community banks or credit unions they don't have tons of resources, and so an instantaneous timeline is not realistic if you had to go out to somebody.
Right.
And so that was very important for us to try to continuously build the process where the lenders trust us to underwrite as a vendor of theirs, and we are an extension of their in-house underwriting team.
Right.
And they trust us and give us the credit guide.
That's really interesting, because then you're not sort of hamstrung or limited, shall we say, to the tech expertise of the community bank or credit union. Also, they're going to have some, but they all have some. right? So you don't need to do like a full scale integration if you're just sort of almost taking their underwriting team for the refi for the student loans anyway and bringing it over to you. So I can see how your addressable market of possible community banks is probably pretty large, right?
Exactly. And that's the amazing part of what we're doing, where we believe that we're taking offline traditional lenders and moving them into the digital age via our platform, because you don't have to invest the resources internally as a credit union or community bank, where you have limited budget, you have limited bodies, and this could go on a 2-year roadmap, if you didn't have someone like Splash that could get live in 60 days. So, this provides for tremendous opportunity to scale an asset category that you want to participate.
Right. That makes sense. So then what is your business model exactly? I mean, is this like a SaaS type model where you're doing like a monthly subscription, or is this you're taking an underwriting fee, or is there a combination? How does it work?
Yeah, we take a loan processing fee and then sort of a lead gen fee. As you think about the two different business models combined, you really have your lead gen and then you have your back end underwriting processing. So we combine those two. There are elements of SaaS to it, but I tend to think of SaaS in a very specific way, which is a per seat license or, a monthly subscription fee or something like that. And we've really stayed away from those types of models because it allows, the way we structure today has better alignment, where we can grow on the front end consumer acquisition side and grow our revenue as a company while also hitting what the banks and credit unions want. Whereas if you have a misalignment and you're charging a per seat or a monthly subscription, you're going to start getting out of whack on the revenue model. And so that's why we like sort of aligning what we're all looking for.
So even though you have your own, like they're running on your software, the loan origination system, it's still on a per transaction basis.
Exactly. Yeah.
Right. Okay. So I want to switch gears just a minute here and talk about your fundraising that you've done. You closed a big Series B recently. So why don't you tell the listeners about that process?
Yeah, so it actually was a unique process because of what was going on in the world with COVID. Mm-hmm. So I've historically been used to traveling around and going to a lot of different meetings, but for this one, you really just stack your schedule with a bunch of Zoom calls throughout a day and over a couple of weeks. But it's about a little bit north of a $40 million Series B. Our investors are great. Some new investors that are joining our group include partners of DST Global, Citi Ventures, Detroit Venture Partners, and a few others. And then we just have great support from some of our existing investors as well, who we're lucky to have, such as CMFG Ventures, Northwestern Mutual Future Ventures. So we've just been lucky over the years to find such great investors that are willing to support our vision and where we're trying to take the company, and then who also really share our corporate values. That's been very important to us as well.
That's great. Yeah, congratulations. So we're almost out of time, but a couple more things I want to get to. I'd love to get a sense of the scale you guys are at today. I mean, can you maybe give us some metrics there?
Yeah, so at this point, we're doing billions of loans. We are working on actually expanding out into new asset categories. So it's really important for us. If someone goes to Splash right now, they would see us as a student loan refi only company.
Right.
But we are working on expanding out a couple other products to further support our mission of enabling a faster and less expensive financial world. That's not just student loans. People have debt in a lot of different categories. People are struggling in a lot of different ways. And our goal is to really help provide lower cost of capital with banking credit union support and do it as quickly as possible. And so that's really what we're focused on.
Right. And what's your headcount these days?
Headcount is we just cleared 100. We'll probably be 180 or so by the end of the year. I think back to the days of early 2018 when we were 5 people or 7
Right.
people, and the scale is pretty immense at this point. But as we continue to scale the company, we have a lot of interest in talent. I know tons of people listen to this podcast, so if you have any interest in Splash, we're a completely remote company looking for amazing talent. So definitely hit us up.
And so you're based in Cleveland, right?
We're based in Cleveland. Prior to the pandemic, we're hiring everybody in Cleveland.
Right.
And the pandemic has been terrible in so many ways, but I think it helped open up our eyes and the world's eyes really to remote work and how you can just look at scaling a company with the best people wherever they're located versus a 15-mile vicinity of your headquarters.
It's limiting when you've got the whole nation out there, or even beyond the country. I mean, you've got a lot of anyone with a good internet connection. It makes it. I mean, I feel like that is. I've spoken to many CEOs in recent months, and they all, pretty much everyone now, hires anywhere geographically. It's not as long as you can do the job. And I think that's a huge change to what we used to do.
You have to, because I can tell you that we've had engineers that were based in Cleveland poached from Facebook and Amazon came in and are stealing our engineers. So we're grabbing engineers from Facebook, Amazon, Apple, Google. Everyone's competing for talent, and if you keep with the old school mindset of everyone needs to be located in one area, some of the best companies in the world are going to grab your talent, but you're not going to be able to go outside of your vicinity, and you're going to be left with a reduced talent force. You're just going to struggle.
Right. That makes sense. Okay, so the last question. I mean, you've sort of talked about a few things that you want to have coming down the road, but as you look out over the next 6 to 12 months, what are you mainly focused on?
We're focused on a few things. I think the first thing is speed. So trying to do everything we can to make the process as easy as possible for consumers. And that involves automation, that involves removing unnecessary processes from a form. So that is definitely core to what we're focused on, which is dramatically scaling up our engineering team to focus on automation. The second is product expansion and trying to recognize that there's a big opportunity in unsecured consumer credit, as an example, where a lot of community banks and credit unions are not really playing in the space. They have a product, but they're not able to access digital marketplaces because of lack of technology. And Splash solves that. And so we're going to be focused on continuing to support our customers and more customers that maybe don't play in the student loan refi segment. Student loan refi is a very specific category. Sure. You have to have a student loan. And right now you have to have a private student loan, which even narrows it even further.
Right.
So when you think about credit card debt, which is just debilitating to a lot of people, I think there are ways to help people shop and save for that product in better ways than maybe exists today. And that's an area that we're definitely going to look at.
Okay, Steve, we'll have to leave it there. Really interesting chatting with you. Best of luck, and thanks for coming on the show today.
Yeah, thanks so much, Peter. Really had a great time.
Okay, see ya.
Thanks.
I'm fascinated by this concept of intelligent marketplaces. While we've had marketplaces around for years, maybe even decades, they've been mostly a lead gen tool where they'll pass the lead on to one of the lenders. But an intelligent loan marketplace, like what they're building at Splash Financial, is really interesting because it provides a lot of value for the consumer. They know they don't have to go around and apply in different places, and they know they can get a really good deal because they're getting many lenders' input to decide which one would have the best deal for them. So I think Steve is right. There's a long future for these kinds of marketplaces. It's a win-win, a win for, in his case, the banks and the credit unions, and a win for the consumer. So be very interested to see how the progress of Splash Financial takes place over the next few years. Anyway, on that note, I will sign off. I very much appreciate you listening, and I'll catch you next time. Bye. Before we go, I want to remind you about the brand new event from Lended Fintech. Fintech Nexus, the Dealmakers Summit, will be the first major in-person fintech event of the past 18 months. A hand-curated audience of venture capitalists, bankers, fintechs, and debt investors will be meeting face-to-face at an event 100% focused on doing deals. It will be happening in Miami on September 1st and 2nd. You can apply to join and find out more at lendit.com.